Hello and welcome to the BizNews Breakfast Briefing. I'm Lucy Ferreira for BizNews.com. Before we get today's market update from Alec Hogg and the FT's daily news briefing, there are a few articles worth checking out on BizNews.com, featuring a scathing piece on the current state of Patricia de Lille's Department of Public Works and Infrastructure, and the impact it's having on the legal sale and transfer of firearms, among many other essential services. And how the world views South Africa from an excellent interview that the FT's chief foreign affairs commentator, Gideon Rachman, had with South African political activist and writer Songezo Zibi, asking what happened to Nelson Mandela's dream for the country. We also have a damning article from Andrew Kenny looking at Pfizer's recent findings on the COVID-19 vaccine. You can find the links to these stories in the show notes. And now, Alec, it's over to you on the markets.
Thank you again, Lucy, for bringing us up to date. It's Wednesday, the 17th of August, and overnight, let's go through what happened on the markets. The S&P 500 index was up by 0.2%. The Nasdaq Composite down by 0.2%, and here at home, the Johannesburg Stock Exchange was up 1.1%. But the big news is the oil price. Barclays has dropped its forecast for the year for the oil price from $111 to $103. This is on Brent crude. That's the one we follow in South Africa. That's the one that makes a difference at our pumps. Now, Brent crude last night came down 5.5%. It's trading at $92.77 per barrel from $98.30 earlier in the week on Monday. So that's why we're seeing Barclays, and indeed earlier, Goldman Sachs, which a few weeks ago dropped its forecast for the oil price for the year from $140 to $110. A reason for this is because the Russian oil supplies are actually getting through despite sanctions. The EU sanctions are supposedly going to get into full force only in 2023, but for the moment, there seems to be as much oil as anybody wants, and as a consequence of that, the markets are now adjusting. This is helping the coal operations, and we saw a huge improvement in the profits coming from BHP Billiton. Reason for that? Coal. BHP share price went up 6.5% on the JSE yesterday. That was one of the major reasons why the JSE All Share Index went higher, and that was after it released profits for the year to the end of June. They are the highest for BHP since 2010, and it's declared its biggest dividend in the 137-year history of the company they call the Big Australian. In the past year, the company gave back $36 billion to shareholders. Incredible numbers, these, and that includes the spinning off of its oil operation, Woodside Petroleum, which was given, shares in that were given to shareholders. Anglo American here in South Africa did the same thing by spinning off Thungela, its coal operations. And what surprised me was to see that in sympathy with BHP's good results, Anglo American and its stablemate Kumba, the iron ore operation, both went up 4%. Now, this is really surprising because Anglo doesn't have coal anymore. The coal is now sitting in Thungela. And if you look at the detail of the BHP Billiton results, the reason it did so well is because its coal operations went from a loss of, call it $575 million a year before, to a profit of $8.7 billion in the year to end June. So the turnaround number in the BHP Billiton number figures was coal. Its iron ore profits were actually down from $24 billion to $19.5 billion. But here on the Johannesburg Stock Exchange, our traders got really excited by the results. Maybe they didn't look at the numbers more as closely as they should have. We'll see that later. Time will tell. Also on the Johannesburg Stock Exchange, Naspers was up by 4%. This was after the company issued a statement to say it's been buying back shares at a price of 2,452 Rand on average. So that gives you a floor for Naspers, 2,450. The shares at the moment are 2,580, so it's above that floor. But if you're a Naspers trader or shareholder, you can almost write it in now that your shares are going to be worth 2,450 Rand, because when they get to that level, the Naspers management are going to come in and start buying more. Indeed, they might be buying more of the shares even higher up. Reason for that? Naspers owns about 30% of the Asian internet giant Tencent. Up until now, Naspers has not been able to sell those shares at will. But earlier in the year, they made a deal with Tencent, and in effect, they can sell as many Tencent shares as they like to buy their own shares back and to close a discount between what Naspers is worth, including Tencent, and what the market is valuing it at. On the way down, Richemont here on the Johannesburg Stock Exchange lost 2% to 194 Rand a share, but that's just a breather in the run that it's had. It's moved up from 150 Rand in May. And MTN was down 1.5% after results, but nothing to worry about there because when its results came out, the share price went up, and it's also just taking a little bit of a breather. Okay, over to the United States. NASDAQ was down a little, as mentioned earlier, but the Dow was 0.7% higher, and that's a bit of a triumph for the old economy stocks, and that was due to better than expected quarterly results released yesterday by Walmart and Home Depot. Those are retail operations. Walmart was up 5%. The share price, as a result, Home Depot was up 4%. And what they're telling us is that consumers are buying down, and they're buying house brands. It's a little bit like here in South Africa. If people went into Woolies and instead of buying the branded products, they would buy the Woolworths brands, or indeed, a better example would be at ShopRite or Pick n Pay, where they would go in and buy the house brands rather than the branded products. The other news coming out of the United States was that higher interest rates, which have been driven there to cut back on inflation, seem to be working in the housing market. Housing starts declined in July and now down almost 10% month on month. The building permits are also down by about 2%. So this is being interpreted as the Fed's intention to slow down the economy is starting to have an impact. Overall, the major markets, the Rand, it lost 2 cents against the US dollar yesterday. It's at 16 Rand 41, so not a lot to talk about there. Against the pound, it was up 6 cents to 19 Rand and 86 cents, and then it didn't move against the euro. The gold price down by about 0.5% from 1782 to 1775. Bitcoin, after its fantastic run, seems to be consolidating at the moment. It was down by 0.2%. $24,067 is what one Bitcoin will cost you. And the Geltec basket down by 2% to 463 Rand and 31 cents. The portfolio stocks held in the BizNews model portfolios did, again, as you could imagine, NASDAQ didn't do a heck of a lot. So as a result, most of the stocks in those portfolio, we have been focused on exponential shares, were steady to some declines in the wild cards. We saw a 2U down 3.5%, which is interesting because the shares are now trading at $8.72, and there is a bid on the table at $15 a share from an Indian company. Clearly, there's a Elon Musk Twitter kind of a view amongst certain shareholders that perhaps that deal is not going to go through. The other one of our wildcards to come under pressure yesterday was Zoom, which was down by 3.5%. Spotify was down by 2%. On the other side, Amazon picked up 1.1%, despite news that another one of its distribution centers is going to have a vote whether or not the members would be joining a trade union. Most of the votes that these have been had have seen the Amazon workers saying, no, we don't want to be unionized. But every time there is a suggestion that there could be unionization, it does hit the news. Into Asia, to close off with, the markets there are strong this morning, which would suggest that the Johannesburg Stock Exchange will hold on to that good run yesterday. The Nikkei 225, that's the Japanese index, is up by 1%. And in Hong Kong, the index there is up by 0.75%. In Shanghai, it's slightly higher.
Good morning from the Financial Times. Today is Wednesday, August 17th, and this is your FT News Briefing. Amazon says U.S. regulators are harassing Jeff Bezos and other top executives. Softbank's rotten year keeps getting worse. And WeWork's infamous founder, Adam Neumann, is back with a new venture.
So far, most people I've spoken to seem completely baffled by the whole thing.
But it is still attracting some really big-name investors. I'm Marc Filipino, and here's the news you need to start your day. U.S. regulators have been investigating whether Amazon uses deceptive tactics to lure customers into signing up for the company's hugely profitable Prime subscription service. But now, Amazon is pushing back. It's accusing the Federal Trade Commission of harassing top executives, including Jeff Bezos and current CEO Andy Jassy. Here's the FT's Dave Lee with the details.
Basically, Amazon thinks and has said the FTC is out to get them, that it has, an agenda, a vendetta. This is mostly because the new chair of the FTC, Lina Khan, has, risen to prominence because of academic papers she's written that basically says she believes Amazon is a monopoly and needs to be broken up. In this particular investigation, Amazon's complaint is, firstly, they're saying the FTC staff have been acting erratically. They said they were suddenly making loads of demands on Amazon staff, giving them only a few weeks to comply after previously kind of going silent on this issue for several months. And one of the things the FTC did, according to this filing, is they served 19 employees and executives at Amazon, some current, some former, with what's known as civil investigative demands. They're basically, subpoenas to testify. And, Amazon said they did that separately from Amazon's legal team, i.e. they went directly to these employees and executives, and they've been standing in the way of Amazon being able to represent those employees and executives.
Yeah, which Amazon says is against the law. So as far as harassment goes, Dave, does Amazon have a point here?
I mean, look, it does certainly suggest that the FTC has more recently become much more aggressive towards these companies. Amazon was given a matter of weeks to reply to those CIDs, which is a very, very short time frame. Now, whether Amazon has a point or not depends on your view of, maybe this is how the FTC should have perhaps always been operating when it comes to enforcement. But, there are some that are seeing this as a step up in terms of the pressure and aggression from the FTC. And we're seeing that not just in this Amazon case, but in the way that the FTC is tackling issues around Meta, the Facebook parent company, and also some of the other tech companies as well. So this is a new era of FTC enforcement.
Dave Lee is the FT's San Francisco correspondent. Softbank is having a miserable month, a miserable year, actually. The world's largest technology investor last week reported a record $23 billion loss. Its shares are down more than half from last year's peak, and several top executives have left or stepped down. Now, the FT's Arash Massoudi reports that one of Softbank's big investors, the hedge fund Elliott Management, has dumped almost all of its position.
We don't have a precise date, but we know that it took place roughly around the time when the stock market was tanking, and in particular the stock market for technology stocks. So that's probably in the February to, let's say, June period. And we've also reported that they had previously sold down part of their stake and took a big profit last year at some point in the middle of the year. And SoftBank shares at that time were performing much better than they are today.
Arash says Elliott had been losing its patience with SoftBank and its founder Masayoshi Son for a while now.
Elliott and other investors, in fact, in SoftBank were becoming frustrated that SoftBank was not proceeding with share buybacks. And if you recall at that time, Masayoshi Son actually doubled down on investing on startups. And this is just at the peak of the bull market in tech stocks. End of last year and into early this year was the top of the market. And Masa Son doubled down on spending the cash that he had on hand on tech stocks, many of which have already blown up in his face. So there was already a growing frustration within the Elliott camp that Masa Son was more focused on investing and taking risk than he was returning cash to shareholders.
Arash Massoudi is the FT's corporate finance and deals editor. Adam Neumann is the eccentric entrepreneur who founded WeWork and took the office-sharing company to a $47 billion valuation before blowing it up. He failed to take WeWork public a few years ago and was kicked out of the company. But now Neumann has another real estate venture in the works, and he just netted a $350 million investment from a top venture capital firm. Robin Wigglesworth is our Alphaville editor, and he has something to say about all this. Hey, Robin.
Hi, Mark. How are things?
Things are good. So Newman's new venture is also in real estate. It's called Flow. Can you tell us what it is exactly?
That's hard to say, really, because it seems he's managed to basically sell a very, very rough idea to Marc Andreessen of Andreessen Horowitz for $350 million. But it seems like he's basically going to do what he did with WeWork for commercial property. He's now going to try to do with residential property instead.
Robin, forgive me for maybe being a little clueless here, but isn't the residential version of WeWork Airbnb?
Well, basically, yes. I mean, that is one thing. Or it could be gated communities. It could be student dormitories, right? This is not new. I mean, it's obviously a popular pastime of me and others saying to VCs that they're basically trying to reinvent things that have been around for decades, if not centuries in some cases. Adam Neumann managed to extract quite a few $100 million out of Softbank, the main investor of WeWork, for walking away. And he's turned that money into a portfolio of residential property in places like Florida, and he's going to use that for this new venture. But what they're going to do beyond installing beer taps and tequila bottles and giving it a Swiss branding is beyond me.
So first of all, let's just back up a little bit. Andreessen Horowitz is a big Silicon Valley venture capital firm. What does it say about why it put faith in someone like Adam Neumann, whose last venture flopped?
I mean, flopped is very charitable, right? I mean, completely bombed in many respects. Yeah. No, and that's the weird thing. Andreessen Horowitz, and led by Marc Andreessen, is definitely part of Silicon Valley's royalty. They are seen as one of the smartest investors in early stage companies in the world. And this is the single biggest check they've ever cut to anybody. So, people are kind of looking to see what he might be seeing that they're missing. But so far, most people I've spoken to seem completely baffled by the whole thing.
Yeah, it also makes me think, maybe people are squinting to try and see something that's actually not there. Does this say something more largely about maybe we've run out of places to put money into and we're trying to stretch things?
Yes, and I think that might be indicative of a venture capital world that has raised an insane amount of money in recent years on the back of, incredible returns. And now that the water is receding because of higher inflation and rising interest rates, and the venture capital world doesn't look quite as hot, some people are kind of retrenching, but these venture capital firms have raised a lot of money already that they have to deploy or hand back to investors. So maybe this is just them flinging money at big ideas before they have to maybe hand some of this money back to investors. But we'll wait and see, because, Adam Neumann did build WeWork up. Maybe he'll manage to do something that is more than just a fancy gated community for young hipsters.
So it sounds like you may not put your money into this.
No, I think I can think of probably at least a half dozen other heinously crazy ideas I'd rather finance with Wiggles Capital's money before I invest in WeWork 2.0.
Fair enough. Robin Wigglesworth is the editor of the FT's Alphaville blog. Thanks, Robin.
Thanks for having me on again.
Before we go, you ever wish you could get a Harvard MBA for free? The prestigious business school just announced it'll do just that for lower income students. It'll waive the $76,000 a year fee for about a tenth of its incoming class. It's a response to concerns in the U.S. over the cost of higher education and social mobility. But even after the hefty tuition is waived, students will have to come up with about $35,000 for living costs and insurance, which the school won't cover. You can read more on all of these stories at FT.com. This has been your daily FT News Briefing. Make sure you check back tomorrow for the latest business news.
And that's all from the briefing for today. If you enjoyed this episode, follow BizNews Radio now to get all of our interviews and daily market updates as soon as they're published on your podcast platform.